A very good evening to everybody. We welcome you to this virtual seminar, to this session on CARO 2022 important updates. We have with us today very learned faculties to take you through this. Yagnesh bhai is a champion in as far as Ind AS and CARO and company law matters go. So I'm sure it would be a very enjoyable session for everybody. Before we start the session, I would request everybody to come to attention for the ICI motto. Mishraji, can we have the ICI motto, please?
येष सुप्तेषु जाग्रति येष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Thank you. So the year 2021-22 is likely to be a watershed year for auditors as such because of the enormous increase in our scope and responsibility that has been cast on account of the amendments to Schedule 3 and as well as introduction of CARO 2022. And today specifically so this refresher course was launched specifically to keep our members updated on the increased compliances as well as our own responsibilities as well as increased disclosures that are required. And today we have with us CA Yagnesh Desai, who will be taking up what are our enhanced responsibilities under the new CARO, which is applicable from 21-22. It was to be applicable from last year, but then it was postponed. But now there is not likely to. We do not expect any postponement, and so yes, 21-22 is a year when we'll have to look at all the new points that are there in the CARO 2022. So I think it's a very onerous responsibility on us. As Yagnesh bhai said while we're discussing that कहना बहुत कुछ है, समय कम है, but I'm sure Yagnesh bhai will be able to take all. As I said, he's a champion faculty, so I'm sure he will cover everything that is required, and everyone of us will go enlightened from here. We have with us also C. Chintan Patel, Regional Council member, and who is the chairman of the Ind AS and AS committee. So I'll now request Chintan bhai to kindly give his welcome address. Chintan bhai, yours.
Thank you so much, CA Rahul bhai, my council colleague and vice chairman of the accounting Ind AS committee. When Rahul bhai is there, I'm also rest assured about everything which is happening, because today morning also we discussed about having a AS refresher course, and he has been working tireless to see that we have the best of things available. Thank you, Rahul bhai, and we'll do a lot of many activities during this year. Faculty of the session, CA Yagnesh Desai, my dear friend. He's a senior person, but we have rapport such that I can definitely say dear friend. Then CA Ishwari Javani, council colleague, and the coordinator CA Sanket Shah. Seniors and friends, good evening all of you. This is the second day, and second day of the session is one of the most important thing. First day we discuss about the Schedule 3. Second day is the CARO. In CARO, obviously there are many Schedule 3 amendments which are the same as the CARO. So when the Schedule 3 was amended, CARO amendments are also going to this on same part. So I'm not going to talk more here, but I think there are three important things from my point of view which I believe is the most critical as an auditor. I'll just touch upon one liner on these 3 points. First point is that only one word has been added, is a deemed deposit, and there are many paragraphs that are modified. but only in the whole paragraph, only one word which has been added, deemed deposit. It has really changed lot many responsibility practically on the auditors. Second very important thing is about the in case of any financial loan has been taken, working capital loan is taken based on current assets. Working capital loan based on current assets where sanction limit is more than 5 crore. Practically, we are going to face a lot of issues and challenges where the statement which is submitted to the bank and financial institutions, and are they in compliance with the books or not, that we have to see. In my view, second very important point. Third point is that where we are required to review basically aging, financial ratios, understanding of the company's business, knowledge of the director's plan, and then we need to assess that whether the company is in a position to and capable to make payment in next 1 year. I think that's like studying a lot of things and providing conclusion on the capability of the company. And in my view, these three are the one of the most important issues, along with many other issues. I'm sure that Yagnesh Bhai with us is going to have a wonderful knowledge and experience of dealing with these issues, and he has already mentioned that he is going to respond to each and every query irrespective of the timelines. That is the commitment and determination of Yagnesh Bhai. Now with this handover, thank you Rahul Bhai, and handover charge to you.
Thank you, Chintan Bhai. Yes, indeed, some very critical changes, and it's likely to be a very difficult year for us. That's what I foresee. So I'm sure Yagnesh Bhai will explain us and give us the methodologies by which we probably can make these things a little easier for us. I would now not take much time and request my council colleague, CA Ishwar Himani, to kindly introduce the faculty for today, CA Yagnesh Desai. Ishwar Bhai.
Thank you, Rahul Bhai. Respected our today's faculty, CA Yagnesh Desai ji, my respected council colleague Rahul Bhai Parikh, Chintan Bhai Patel, and our coordinator Sanket Bhai Shah, and my dear members. Very good evening to all of you. It gives me an immense pleasure to introduce our today's speaker, who is in 40th year of his practice. He is CA and CPA USA. He has been member since 40 years. He has been practicing since 1983. Has wide knowledge of audit of corporate taxation matters. Is actively associated with activities of Institute of CS. He has been a trainer of IFRS for certification course of Ind AS conducted by ICI, and trainer for diploma in IFRS examination conducted by ACCA of UK. He has composed and delivered e-lectures for accounting standards for ICI. He has been a speaker on accounting and auditing standards at various seminars of ICI. He has also delivered motivational speeches at various national conventions and student conferences. I still remember when I was Vikasa chairman, when he has been a faculty in national conference, and students also still remember him. So he's very much motivational speaker also. He has trained many CPAs of Philippines on IFRS. Between April 2009 till date, he has delivered 1081 sessions and seminars in about 40 cities in India and abroad. This is his 1082nd session, and recently has been awarded Icon 2021 of Mumbai City by Times Group. With this, I introduce before you CA Yagnesh Desai, who is very much there on Ind AS and IFRS. Thank you, sir.
Namaskar, good evening, everybody, and
Thank you, Ishwar.
thank you, Chairman sir, for remembering me, Chintan Bhai, and Rahul Bhai also for nice words, and Ishwar Bhai for putting nice words for me. I really appreciate it. It's my honor to be here, and I had always mentioned that Institute has groomed me. It's my duty to say, to serve my mother, and that's ICI. ICI for ICI, no conditions apply. And as Chintan Bhai has said very correctly, today's CARO 2020, which was introduced in 2019 and was supposed to be applicable 1920 and 2021, has been deferred till financial year 21-22, and very correctly observed by you, Chintan Bhai, because I know you are also faculty and you're also YouTube channel speaker, so you know it well that The one word, deemed dividend, the deemed deposit, has a very devastating impact, and that itself will take nothing less than 2 hours. Plus the current, the limit, working capital limit costing 5 crore rupees. And then again, the last one is accounting ratios. So they want a chartered accountant not just to play a role of an auditor, but also a clairvoyant, ek bhavishya veta ki bhati. They want that you should now give this thing that whether the firm will, the entity will go on for next 1 year or not. It's just beyond going concern only. And responsibilities बढ़ रही है मगर fees नहीं बढ़ रही है. That's a big challenge. If you compare practice 5 years back and today, there's a lot of difference. So can I start my presentation, friends, sir? Okay, thank you very much once again, all of you, and I try my level best. I have requested through Chintan Bhai to Mishra ji that note down all the queries. If I'm not been able to solve it today, my words and undertaking and commitment that by this Sunday, I will answer all queries, word by word, and email it to WLC.
Fantastic.
For the benefit of all my professional brothers. Okay. So can you see the screen on your, hello, can you see the screen?
Yeah, it's visible.
It's visible. Okay. Thank you very much once again, WLC. And my first 10 slides, I will be, I have earmarked to the fundamentals and the foundations. These are just some the routine data record for the statistical purpose, that how many clauses have been added, no changes in few clauses, and in some cases the scope has been expanded and only one clause has been deleted. So this is the abbreviation. I'll call it the order, the Companies Act CA 28, 2013, Ind AS and AS. I must acknowledge the tremendous reliance placed by me on the guidance note to the Companies Auditors Report 2020 issued by ICI. It's a wonderful statement. It's a wonderful document brought by the ICI. And I owe credit for all this to ICI, this guidance note. And a few of my colleagues who helped me out, and I'm going to share one Excel sheet with you all, which has summarized all the tables which is mentioned in the guidance note, despite the fact that these have been just copied, but it's a very humongous task, and for that credit goes to my colleague. Now, as mentioned by me, that first few 10 slides I'm going to earmark only for the foundation. The exclusion of CARO had been determined, but that means it's not applicable to banking company, insurance company, company license under Section 8, which is now Section 25 under the CA 813. And then the private limited company not being a subsidiary holding of a public company, a paid up capital and reserves in the surplus not more than 1 crore, and which does not have the total borrowings exceeding 1 crore rupees, and which does not have a total revenue. Now the income as disclosed in Division 1, 2, and 3 of the Schedule 3 of the Companies Act. Chintan bhai, can I ask question? Can I ask one of the participants to be participative and answer my question, Chintan bhai or Mr. Mishra, please? Hello. By the way, how many participants today, sir? Hello. Chintan bhai, can I ask a question? Is anyone willing to answer this question? What if the company is a small company and its turnover is more than 1 crore rupees? Would anyone like to answer this question, please? Hello. Chintan bhai, can I ask question or should I straight go and explain it?
तो चिंतन सर नहीं है.
नहीं है. अच्छा, तो आपको मैं पूछूं, जो भी है मौजूद है, can I ask the question? Is any of the participants would like to answer the question, be participative and make this session very live, interactive? Okay, now let's. I think how many participants, by the way, Mr. Mishra?
300.
300. Okay, fine. So a company may be a small company, and you must remember now the small company definition in the criteria has been changed, modified under the Companies Act. And for financial year 21-22, the small company is a company which paid up capital is more than 2 crore rupees, and its turnover not more than 20 crore rupees. Earlier, the threshold was 50 lakhs for the paid up capital and 2 crore for the turnover, but now has been changed. Now, the point is that if a company has more than 1 crore rupees of a paid up capital, do you think it will be captured by this exemption? That means, will it be deprived of the exemption? Answer is no. Answer is no. And that's why I have given in some places the paragraph number of the guidance note. Exemption to small company continues even if it falls under any of the criteria specified for a private company. So even if a company is a small company, and even if it's and its paid up capital is more than 1 crore, rupees, then it will be still claim, it can still claim exemption from the CARO. Then effect of conversion to an exempt category, like a private limited company is converted into LLP or a partnership firm, then the order will not apply. The order is also applicable to the audits of the branches, and it will not be applicable to the infrastructure investment and RETI companies because they are governed by the SEBI. Very important, while calculating the paid up capital, amount of the unpaid calls unpaid should be deducted from the amount originally paid up on the forfeited shares, and the amount originally paid up on the forfeited shares should be added to the paid up capital. So the unpaid calls should be deducted, and the amount originally paid on the forfeited shares should be added up. Share application money received should not be considered as a part of the capital. Convertible instruments should be considered in the paid up share capital only when the actual shares are issued by the company. And this is applicable for the Ind AS company. And if my friend Mr. Venkatji is there, he'll get this news will smitten him that there is something called the convertible bonds, and that bonds are to be split into debt and equity as per the Ind AS requirement, as per the Ind AS 109 requirement. So as far as this criteria is concerned, one should forget about the equity portion, and that is to be treated as an equity only when they are actually converted. Again, most frequently asked question, treatment of the revaluation reserve for determining the capital and reserve. For Division 1 companies, the following to be taken into consideration: capital reserve and revenue reserve. And equally important is the revaluation reserve is to be considered for the purpose of calculation of the net worth of the reserves. Debit balance or the P&L to be reduced, and all of them form part of the reserve and surplus. This is there in para number 19 of guidance note. When it comes to the Ind AS company and Division 2, the followings are not considered as a part of the reserves, and that's the equity component of the compound financial instrument, debt, equity adjustment to the OCI, income OCI, then the effective portion of the cash flow hedge, and the exchange differences on translation of the foreign statement known as the FCTR and other OCI items are not added to the reserves and surplus. Para number 20 for your reference. And para number 21 says that for the NBFC, everything which is there in OCI, or for that matter, the statement of changes in equity as SOCI, will be forming part of the reserves and surpluses. This is just to make things clear, because at many platforms I have come across these questions. And now we'll go by the analysis of the clauses. Wherever there are changes, you can see this at the right top corner. There's a red mark. That means these are the changes. I need to spend a little more time than otherwise. The only change which is made in this clause number 3IA is the name which has been changed from the fixed assets to the property, plant, equipment, and this is to be in line with the AS 10 and Ind AS 16. Well, CARO was introduced in 2019. CARO 2020 was introduced in 2019, and at that point in time, the Schedule 3 were not changed. The changes in the Schedule 3 were made only in March 21. So the first came the CARO 2020, and then the changes in the Schedule 3 to the Companies Act. All divisions across the board, division 1, 2, and 3, and there they have changed this nomenclature from fixed assets to the property, plant, and equipment. Okay, so now in fact Schedule 3 also has been amended to some extent to be in line with the CARO 2020. Well, there are some clauses which are related to in the CARO, which has been replicated in the Schedule 3 changes. So here one simple change, that is nomenclature has been changed from fixed assets to property, plant, equipment. This phraseology is used in the Ind AS and also in the revised AS 10. Now, intangible asset is a new clause. They say that whether the company is maintaining proper record showing full particulars of the intangible assets. This sound very innocent, and we may think, oh, what's the big deal in the intangible assets? No, it's very simple. We all know tangible, intangible assets, so there should not be a problem. But the challenges arises in terms of the Ind AS 38 and AS 26. Intangible assets, and more so for the internally developed or the generated intangible assets. Mind you well, internally generated goodwill is not permissible, but an entity can definitely recognize the internally generated intangible assets. And I'm sure you now remember the age-old definition of and two stages: A, research; B, development. All expenses incurred during the research stage are being expensed out. And on completion of the additional 6 criteria about the technical feasibility, financial viability, resources availability, and asset, intangible asset is recognized. So important is that at what stage the intangible asset, which was a capital work in progress, was being recognized. So this is a very critical thing. And I would say that in case of a merger, I won't call it in case of a consolidation only, but more so in case of the merger, when the acquirer acquires the other company, that is known as acquiree, it has to recognize certain assets, intangible assets, which were not even recognized earlier by the acquiree, like the customer list, then the non-disclosure agreement, non-compete agreement, and mistakes and the title of the product and all kind of thing. So even those need to be taken into consideration as the intangible assets. Intangible assets also are under the Ind AS 38. It gives 2 options: A, the cost and revaluation. We'll see revaluation bit later. Now the clause 3B, you can see here the mark at the right corner is green. That means I don't need to dwell much upon that because this clause was already there. It has just been repeated. So allow me, my dear friends, because the focus today is only on the changes which are being brought out. And if you permit, I may also skip some of the PPTs and move to deemed deposit, and even the ratios and the working capital, what has been mentioned by Chintanji. As far as this is concerned, 3(1)(c) is concerned, whether the title deeds of the immobile properties, now this is also there, but there is one modification. So it was there earlier in the, again, this has been brought in by the Schedule 3 also. So here need to see the title deeds. If the assets is there in the books of account of the company, it has been recognized, but whether the title deeds is there in the company or not. For land, we refer to the land record, something called Index 2, and for the agricultural property, we see 7/12 extract, and 8A and 6A. For the properties in the cooperative societies, we insist on the share certificates. It's very simple for that. And so the point is that it is required that if entity has recognized certain assets, immobile properties like property, plant, equipment, then make sure that they are in the name of the company. Incidentally, I draw your attention to section 187 of the Companies Act CA 2013, which requires that the properties and investments made by the company should be in the name of the company, and for non-compliance there's going to be heavy duties, in which I mentioned here. But the point is that you should make sure that yes, it is there. And now I was referring to a table which has been prepared by my colleague. This is the table these are the tables, right? I would say, and in case the entity, in case the entity has property, plant, equipment which are not in the name of the company, then they have to, the auditor has to give in this format. The reporting has to be done in this format, because it's quite possible that there is a merger, there is a business combination, and in principle everything is being agreed, but the department or the agencies or the regulator takes some time to transfer the name into the company's name. Like this, there are many distinct friends. I'm going to share this with you as well. But allow me time, a day's time, I'll improvise it, because you can see there's a slide number mentioned here. So once I formalize all my slides after making few valuable additions, I'll update this and share with you. And this is my commitment to you, not just promise. So like this, for all the clauses, wherever there are table prescribed by the guidance note, a team has prepared these tables which I share with you. You also can copy it, no denying, but this will make your things very easy. Now, in the bracket, they say, other than properties where the company's lessee and the lease agreements are duly executed in the favor of the lessee. I'm sure you all must be knowing that as far as lease is concerned, there's a new standard which is called Ind AS 116, and this standard has replaced the erstwhile Ind AS 17. So obviously, when an entity is taking any assets, a lessee is acquiring any asset under the lease agreement, the title may not be transferred in the name of the lessee. So they say that other than the properties where the company is a lessee, so they say save and exit the lessee. But then make sure that as far as the make sure that the accounting is classified properly. The under Ind AS 116, the assets, or let me use the correct word, the asset which has been identified, which has been specified, which has been earmarked, has been taken by a lessee under Ind AS 116. They should be classified properly, like they are known as the right of use asset, ROU. Well, mind you, well, don't get eclipsed by the word right of use asset. It's not an intangible asset. It is still an asset. So you classify, if I have taken a land for just a period of 10 years time, and the land is identified, land is specified, and the lessor has no substantial right to substitute the land, and I am entitled to use the land throughout a period of 10 years time. I take this land, I recognize this land in my books of account as ROU, land, and I will even depreciate this. Yes, you may be surprised that how the land is being depreciated, but I am not talking about the land, I am talking about the ROU land. All right. Now, immobile property, the word uses immobile property and not the property, plant, equipment. There's a lot in this CARO. I was sharing my thoughts with the all conglomerate from the WRC. हमारे प्रधान सेवक जो है WRC Institute में, I was discussing with them. Yes, you are sevak, you are doing a great job for Institute, and आपको Chartered Accountant brothers at the cost of your personal life. Salute to all the WRC and Central and Regional Council members. As of now, there is a special stream of specialization about the CSR. There are some chartered accountant who are specializing only in CSR. And like this, a day is not very far where someone will specialize only in CARO. So much is the complications of the CARO. The word used by them is immobile property. Now, immobile property can be property, plant, equipment, or it could be an inventory as well. Like inventories also could be immobile property. But what is the spirit of this standard is not to apply this immobile properties, this clause to the immobile properties which are not classified as property, plant, equipment. So this is very important. Immobile property is not classified as a property, plant, equipment, like inventories of immobile property for a real estate company. So this clause is not applicable to such immobile properties. Now, when it comes to the, now we say that immobile property, if it is classified, let me see, please. Okay. Another set of immobile property need not necessarily be the property, plant, equipment. but it could be, as I told you, the ROU asset, and it could be a non-current asset held for sale as required by Ind AS 105. So even thus, these assets are also covered by this clause. So I would say, save and except the inventories, this clause is applicable to a property, plant, equipment, and also to the ROU asset and the non-current asset held for sale, regardless of the fact that they are not classified as the investment property. And now comes a very important topic, very important change, and that's the revaluation. That's the revaluation, friends. Again, I acknowledge time and again the credit goes to the guidance note, which I have read threadbare. And I must say and advocate and suggest that, friends, you must read this this very important, I call the epic document called the guidance, line by line, word by word, and then I'm sure, and you cannot go wrong. It will take maximum 4 to 5 full working days, but please do that. Now, obviously, this covers the property, plant, equipment, and revaluation model is there are two models: A, revaluation, and B, the cost model. Now, this is not applicable to the cost model, obviously, because of the cost model entity, even for the subsequent measurement, continue to recognize property, plant, equipment at cost only and not at revaluation. Whether the company has valued the property, plant, equipment, including right of use asset or intangible asset. Oh, my dear friend. So they are covering PPE and the right of use asset, and as well as the intangible assets also fine, because property, plant, equipment does cover these three items, both during the year, and if so, whether the revaluation is based on the valuation of the registered valuers, specifically specify the amount of change. So ask a question: has the revaluation been done? Yes. Second question: by how much it has been done? Okay. And if third question, are the changes more than 10% or more on the aggregate of the net carrying value? My dear friend, the word used is the net carrying value and not the cost. And we know what is the carrying value: cost minus accumulated depreciation, accumulated impairment, and accumulated amortization is known as the net carrying value of such class of property, plant, equipment, or the intangible assets. They have forgotten ROU there, but regarding ROU, I'll also come back a little later. So first, you need to see that whether the entity is following the revaluation model. Well, I'm not going to discuss the things about the accounting treatment as to whether you should provide the DTL or DTA, because otherwise it will be too long a session. So then we must see that valuation is done by the ROU. Now, as far as Ind AS is concerned, it does not insist that it should be done, the revaluation should be done based on the valuation report by the registered valuer authority, registered valuer, but Ind AS mention is very clearly that it has to be based on the RVO certificate. Now, when it comes to the RVO, it reminds us of Section 247 of the Companies Act, wherein for a listed company, the registered value is appointed by the audit committee, and for the non-listed company, the RVO is appointed by the board of director. And that too, mind you well, he has to be first appointed, and then he has to give the valuation report, and not license. One more thing, sir. Revalued amount, the assets which have been carried the revalued amount, assets which have been carried at the revalued amount, ideally should be presented separately in the financial statements, like property, plant, equipment carried at cost, property, plant, equipment carried at the revaluation amount. There's one catch here. And now this, now my Ind AS, my Ind AS, will get alive now. Ind AS 16 requires that the revaluation has to be done on all the items in a class. You may follow the different model for the different classes, but within the class, there is no cherry pick model. I'll explain you. Land, building, computers, furnitures, vehicles, these are known as the classes of assets. Like land is one class, building is another class. Third is the computer. So they are known as the classes. Say for example, you got 10 pieces of land and you decided to revalue the property land at the revalued amount. You cannot be selective and say that, look, I will value only 6 parcels of land and leave 4 parcels. No, you cannot do so. There's no cherry pick model. There's no option. If you apply the revaluation model to the land, then all the items appearing in the land should be measured at the revalued amount. But you can have a different model for different classes. You've decided to apply the revaluation model to the land, but you can prefer to have cost model for balance all other classes like building, computers, furniture, fixtures, vehicle. There you need to, once you've selected the cost model, you apply the cost to all the item, unless you change from cost to revaluation. Okay, so this is the one thing you should keep in mind. And since we are on the revaluation, I would say that the revaluation pursuant to Ind AS 16 and Ind AS 38, that is intangible asset, is recognized in other comprehensive income net of taxes and gets accumulated in the equity. It is presented in the OCI. At the same time, the balance net of taxes is accumulated in something called statement of changes in equity. And one more thing, OCI, there are 2 categories. One is the item which will be reclassified subsequently to profit and loss account, an item that will not be subsequently reclassified to profit and loss account. The valuation of property, plant, equipment, and the intangible assets falls under the second category, meaning item that will not subsequently be reclassified to profit and loss account. Question arises, then where? Answer is in the retained earnings. Okay, so this is just to revise you and to apprise you of the Ind AS requirement. Now, very important, fair value of the property, plant, equipment upon the first time adoption. We all know that a company, when it adopts the Ind AS for the first time, Ind AS 101 allows the company to follow the fair value model or to stick to the cost. And if the company has preferred to revalue the property, plant, equipment on the date of transition to Ind AS pursuant to Ind AS 101, paragraph D, appendix D, paragraph 5, 6, and 7, then such revaluation is not to be considered as a revaluation for the purpose of this CARO. Then remeasurement due to the interest in foreign exchange. If some entities have opted for AS 11 paragraph 46, and as a result of which changes in the foreign exchange are recognized in the property and equipment, even that is not considered as a revaluation. Very important thing, change in the ROE asset due to the lease modification as per Ind AS 116. So here, just allow me a minute, please. As I mentioned to you that from the perspective of the lessee under Ind AS 116, the identified, the specified asset is recognized by the lessee as ROE asset. How it is measured? It is measured with reference to the present value of the lease obligations. What lease obligations contain, let's not go into that, otherwise it will take another 1 hour. So you find the present value of the minimum lease payments, and your first entry is debit ROE asset, credit the lease obligations. Later on, when there are changes in the lease terms, maybe the lease term is expanded, or the lease obligation undergoes a change, the rentals goes up, the term gets extended, so the lease obligation is restated as a result of the modification of the lease obligation. Then in that case, the Consequential changes in the lease obligation are debited or credited to the ROS. Here we are talking of the increase. So entry in that case would be debit ROS, credit lease obligations. Now there is an increase in the ROS carrying amount. This does not tantamount to revaluation. Using the work of an auditor's expert, but his report can be used as an evidence as an audit evidence with regard to the using the work done by the management expert. So again, AS SA 620 you can rely on that. Well, now they're talking about the Benami properties. Whether any proceedings have been initiated by the initiated or are pending. So whether first is initiated, second is naturally initiated and pending, initiated and not complete, against the company for holding any Benami property under the Benami Transactions Prohibition Act 1988, and now, but this is now been has been rechristened is the Benami transaction by the. Now I must tell you one thing, one history about this. Sorry, it has been same name used. Not this act was framed in 1988, but it was enacted in after about 26 years, in 2016. Why? Because the rules were not framed. And when the act is made without making the rule, the act is of no use. Now here, he has to really rely a lot on the management and also the lawyers, also the income tax consultant, to get an assertion from them that whether any action has been taken by them. So this was again, okay, yes, I was correct, but it is then the second branch. When it was enacted, when it was introduced without any rules, the act name was like this, but the name has been changed in 2016 as Prohibition of the Benami Property Transaction Act. It has been enacted. Interesting story is there about this. Just before the there is an example of the Benami properties. It's given in the definition is subsection A to section 2. Now, next slide is important. What is not considered as a Benami property? Now, the consideration for the property has been provided by the person to whom the possession of the property has been allowed, but the person who has granted the possession thereof continues to hold the property of such thing. I have paid money, okay, but still the seller is still occupying the property. The stamp duty has been paid, and last is the contract has been registered. Sir, I give one tip to all of you. If you want to save yourself from this act, then please get your document registered. Nobody can claim this is a Benami property. How to safeguard yourself from the Benami Property Act? Register the document, pay the stamp duty. Now, if you read the definition of the property, it means rights, corporeal, movable, immobile, etc. It is fine, but very important. And also includes the proceeds from the property. So I want to play safe. So I have taken some property as a Benami property without indulging my name, and then I sell it and get a cash. Even this cash is considered as the Benami property. Now, this is again inventory. Just a minute, friends. Inventory was very much there. There is nothing great and nothing new about it. But now the opinion is sought in this clause. Normally, on the CARO requirement, the report auditor is supposed to narrate the facts and is not supposed to give his opinion. But here, whether in his opinion, the auditor, now the color red indicates that it was earlier in the erstwhile clause only to here. Now they say that whether in opinion of the auditor, the coverage and the procedures of such verification of the by the management is appropriate, and whether any discrepancies of 10% or more for the aggregate of each class. Now, when we say each class means raw material, work in progress, and the finished goods. Inventory were noticed, and if so, whether they have been properly dealt with in the books of accounts. So he is to see whether it is appropriate, commensurate. Are there any discrepancies? And we all know that there always are discrepancies. Then how it has been dealt with. If it is less, then has you accounted for the obsolescence or the loss of this thing in aggregate for each class? The word appropriate is a matter of subjective interpretation and is a matter of professional judgment. Again, I must tell you one thing, that throughout the CARO exercise, you must think of A, materiality, B, relevant auditing standards, and C, which of course a part of the management standards only, the auditing standard of the auditing only is about the management's representation letter. Friends, the guidance note has done a wonderful job by giving the specimens of what kind of reporting is to be done when it is a positive, what kind of reporting is to be done when it is a negative, and also the checklist and the list which you should take from the management as a part of the management's representative letter. We all know that the physical verification has been the duty of the primary duty of the management, but auditor has to observe it. Auditor has to observe it, and that is where the onus of the auditor comes into play. And test count is not considered as a verification of inventory. Final inventory stock, third party. This is very important, more so for the online companies. Third party inventory sometimes may be lying with the third party, the custodians or the godown keepers and all this, and the clearing and forwarding agents. So in that case, friends, you should not only just confine yourself to the certificate from the third party. That's not the only one, but you should also sometime request the management that insist that as a good practice, management should also do the surprise checking. This is a new requirement which Chintanji was very much insisting on that. Whether during at any point of time. Okay, one more tip. Whenever you read the CARO, you should be careful. Is the requirement or the threshold or some numerical limits are at a point in time, that is at the end of the financial reporting date, or at any point in time during the year or previous year? Correct? Keep in mind, at a point in time, at any point in time during the year, and I would say the previous year. The company has been sanctioned working capital limits in excess of 5 crores, so more than 5 crores. What is important? Sanction letter. Which limit? Working capital, not a term loan. From bank or financial institution, or the loans on the security of current assets. Important thing on securities of current assets. Then what do you mean by if I don't take on the security of the current assets? This standard will not apply. Whether the quarterly returns or the statements filed by the company with such bank or financial institutions are in agreement with the books of account of the company, if not, give the details. In this regards, lesser said the better. There is always a temptation on the part of the management to inflate the inventory. to fall in line with the requirement of the banking, because they say that your margin money has to be like this, 20%, 25%, and there's always a temptation and inclination on the part of the management to give little numbers on inflation basis, on inflated numbers. So what is to be kept in mind? At any point in time. So what, as a part of your checklist, my dear friend, you should get the sanction letter from the bank for the working capital. Don't simply go by the balance outstanding on the reporting date. You may be tempted to see the working capital outstanding loan is about, say, 2 crore 50 lakhs. And you are mesmerized by the number of 5 crore. And even then think, okay, sir, don't worry. I remember 5 crore rupees and that's what I can see. But since it is less than 2 or 5 crore rupees, I don't think we should apply it. No, it's not like that. It's not like that. You should insist on the working capital sanction letter. Okay, and make sure that what are the securities offered. Now, when you talk about the securities offered, I would try and link you with the Companies Act, because when you create a charge on the debtors or the stocks and all these, you must say CHG1 and CHG4 form have to be filled up with the MC. I think CGS1 is for creating the charge, and the CGS4 is for the release of the charge. So these are all some documents which you should be looking for and see that whether other details are corroborating with this or not. This is the new clause, whether the company has sanctioned rupees during the year. If yes, now it says no, during it is any point of time during the year. Fine. Now this again, if you read, the more you read, the more you're getting confused. Whether during the year, any point of time, the company has been sanctioned working capital limit. So if it has been sanctioned in earlier year, what do you mean by that? Should this be applicable or no? To my mind, it should be applicable, because going by the spirit of the disclosure requirement. So I would say whenever there is a sanction limit for more than 5 crore rupees, whether sanctioned in this year or the preceding year, you should comply with this. And of course, as a matter of disclosure, you can always say that this limit was sanctioned in year so and so, and it has been secured against so and so. If yes, the company shall quarterly return file with the same note applicable if the limit is unsecured. Very important. And friends, for this again, credit goes to the guidance note, not to me. I have done the work of a सूत्रधार. केवल सूत्रधार की भूमिका मैंने निभाई है, आपके सामने पेश कर रहा हूं और कुछ नहीं. This clause does not require the reporting where such limits are unsecured or sanctioned on the basis of assets other than the current assets. Very important thing. If it is unsecured or secured against other than current assets, this requirement is not applicable. Now, this is a new clause, subclause 3. It is few inclusion. Earlier they has made or invest. Now they say that investment in or company has made investment toward now to provide a guarantee, and this is earlier it was only loans and advances in the nature of a loan, secured or unsecured, to companies, firms, limited liability partnership, or any other party. So it's a very wide coverage. What is added is the investment in. Up here you must be aware of the requirement of section 179, 180, 185, 186, and 187. As I told you, 187 deals with the fact that the investment made by the company, now not necessarily the financial investment, but including the property, should be in the name of the company. And 179 and 180 deals with the board's power of the board and the limitation of the board's power. 185, 186 we'll see later on. This is section 73, 76, 185, 186. I would suggest, and for that matter, all these sections, I would suggest you must read once in a week along with the rules by heart, para by para and line by line, because this is very intricate standard. It's going to be covered today here also. Okay. Now again, it says a guarantee. guarantee of security. Now, if my friend Mr. Venkat Subramani is there, he will be very happy to see this slide, because in case of Ind AS compliant company, guarantee by parent to subsidiary, and for which parent has not charged any guarantee commission fees from the subsidiary. Now, again, this guarantee which we are talking about is a financial guarantee and not any kind of a performance guarantee. So a parent has given a guarantee to the bank or the financial institution for the financial obligations of the subsidiary and not charge any guarantee fees from the subsidiary, then they have to monetize this transaction. They have to account for this as per 10 Ind AS 109. Just keep this in mind. So when you raise a question, a checklist, ask a question: has the company given guarantee for the financial compliance to the bank for the loans or the financial facilities available by the company, and charge any fees or not? If not, then if the company is following the Ind AS, account for the guarantee commission. Now, friends, a few paragraphs I have just kept it like this. I know, friends, guidance note is not meant for me only. I'm not the only privileged chartered accountant member that institute has given me this. But to be very honest and candid, when I was given this task by my dear friend Chintan, he's much junior to me, that's why I'm calling it Chintan Patel. I have gone through this entire guidance note again. We have done this exercise in 2019, but when I read it again in the context of the revised Schedule 3 to the Companies Act, it has really enhanced my understanding. So मेरी हाथ जोड़ से आपसे विनती है, गुजारिश है मित्रों कि please read this guidance note. I know we got everything but time. समय की बहुत कमी है. It is true for you, it's true for me as well. But take my words, read this guidance note line by line, word by word, and you find it is not that difficult. But I can tell you one thing. Then you realize that there is a lot of it. There is a lot to it than meet your eyes. बहुत गहराई में जाना. And when you come across this, any section 185, 186, 187, read with this, sit down with that section and the rules. Sit down with your team on one of the Saturdays, and you see the difference in your output. Being a boss, then you will not find it difficult to monitor. Okay. Then again, these are all requirements to be given as to obtain all the investment guarantees, securities. The details include the name of the parties and all this. This being a routine reporting matter, I'm not delving deep into the matter. But very important is that the sanction letter, sorry, the investment, you have to give the, here you need to give that it is a prejudicial or not, simply give the data of that. That's it. Very important. Loans given but squared up should not be missed out. Because we are often carried by the perception that what is there at the end of the balance, at the end of the reporting period, only are to be supposed to be presented or acted upon or reported upon. That's not the case. Make sure that anything which is being squared up also taken into account. Now, about the prejudicial, this is covered in the para number T. And I tell you one thing, the focus has been a lot on investments, loans given by the company, taken by the company, that is the deposits, and more so whether those have been used for the benefit of the A subsidiaries, B associates, and C joint ventures. In one case, they have used the word only subsidiary and associates. Subsidiary and associate only. Then someone asked me a question, sir, why joint venture is not there? But if you read the definition, joint ventures, associate includes joint venture. Okay. So read with the, sit down with the Companies Act. And I think I would say for the CARO, more than the Income Tax Act, you need to sit down with the Companies Act rules and the standards on the auditing and also the accounting standard to some extent. Now, whether the investments made, guarantees provided, security given, and the terms and condition of the grant of all the loans and advances in the nature of loan guarantees provided are not prejudicial to the company's interest. So naturally they say that they should not be against the company. Like the market rate of interest is 10% and you give the loan at 8%. Normally, when the company would have given a loan to someone else, outsiders, other than those, other than the bank, so sorry. Normally, when the company gives a loan to anyone else and not taking the security, giving the unsecured loans, you also give loans on the conditions payable when able, Those kind of things you should be very careful about, and they are known as the prejudicial to the interest of the company. Oh, very important. This clause is applicable even to non-banking finance companies. Okay, and again, clause number 49, one of the guidance note, page 63, is for the illustration of the reporting. Friends, as I told you later on, I changed my thought and I asked my team to make the reporting format in the Excel file, which eventually will be shared with you. Even this slides also will be shared with you, but allow me a day or 2 days time. I'll just again window dress it and make it more meaningful, okay, sorry, and more presentable, and I'm going to share this with the WRC team. That's my commitment. In respect of loans, this is again a third clause. In respect of loans and advances in nature of loans, again friends, I have put a green mark here because this was there already, okay? So I'm not going to dwell upon that, whether repayments are regular or not. This is the factual thing. If they are irregular, then say they are irregular. If they are regular, that's fine. If the amount is overdue, state the total amount of overdue from more than 90 days and whether the reasonable steps have been taken. This is again the existing requirement, so I'm not dwelling upon. Can you see the right hand side, the green mark? I have given the description for this clause, but I'm not going to dwell upon this during this deliberation, else it will not, I will not be able to cover like this red marks. New clause 3E, whether any loan or advance in nature of loan granted. Now, what do you mean by advance in nature of loan granted? When I give advance for an equipment or goods, I know the company know that yes, you are going to get this equipment or the goods over a period of time, maybe 1 year, 2 years, 1 month, 2 months. But I give the advance for the goods and the value of the merchandise is 1 lakh. The delivery time is 1 month. Cost is, the price is, the price is 1 lakh. The delivery period is 1 month time. I give the loan, I give the advance of 5 lakhs rupees. I give for a period of more than 1 month, maybe 3 months, 4 months, 6 months. This is known as an advance in nature of loan, which has fallen due during the year and has been renewed or extended or fresh loan granted to settle the overdue of the existing loan. Oh. To the same parties, if so specify the agreement, aggregate amount of such loans, dues renewed or extended or settled by the fresh loan, and the percentage of the aggregate to the total loan. Okay. So this is known as Topi Gumana. Okay, I have given you a loan, I'll take it back on paper, and again I'll say, okay, I'm giving the fresh loan. And sometimes you may increase the amount also. Okay, I had given a loan of 10 lakhs rupees, with interest it was 11 lakhs, but now I would exchange a letter that I am giving you additional loan of 12 lakhs rupees, which means but this will adjust the existing loan. So this is about the camouflaging of the loan which is due but not in. Oh, that's a wonderful word I was trying to look for. Evergreening of the loan. Evergreening of the loan. That means the loan is never paid off. Correct? So whenever the due date comes, you of course this word is not defined anyway. However, in general balance, it implies that attempt to mask the loan default by giving the new loan to help the delinquent borrowers to repay, adjust the principal or pay the interest or the old loans. And I have put a word insert table, which is already there in the Excel sheet, which is going to be shared with all my chartered accountants fraternities. So what is the whole idea of this? In the absence of this clause, an auditor would have skipped the coverage of this item. I would say reporting rather than the coverage. Absent this clause, this would have gone without any notice, but which is in a way a dangerous thing. So what as an auditor you should do here? You should ask the maturity table of a loan. See if it matured in the year, the same party is being given the loan. Is there a moment in this thing? So all this is to be taken into account to find whether the evergreening or the camouflaging or the masking of the loan is done. Fallen during the year and has been renewed or extended. Okay, so this is E and then F. 6 clauses about the loans, investments, advances in nature of loan, and all this. And same is the case with the in loans, investments, amounts given to the subsidiaries, securities, guarantees, etc. given to the subsidiaries. Where the company has granted in loans and advances in nature of loans, either repayable on demand or without specifying any term or the period of repayment. If so, specify the agreement about the percentage that to the total grant granted. Okay, so here they are going to capture that how much is payable on demand, how much is repayable within the specified term, and where the period of repayment, whether the term of repayment is there. The question arises where there is no repayment schedule, what will happen? This says that all the period of repayment, the triggering question is what if there is no repayment period? Requires the reporting of the gross amount in respect of loan. So here again give the details, either payable on demand without specifying any terms of the, if response is yes, the auditor is required to report the aggregate amount of loans. So this is just purely a reporting mathematical exercise. And why does it say 550? Yes, to promoters, related parties. So we are confining ourselves to promoters and related parties, but later on you'll see they are going to add the subsidiaries, associates, and JVs also. So idea of expanding this reporting requirement under the CARO is to capture things which otherwise would have missed out in the auditor's report. Sometimes quite rightly so, but that is not requirement of the audit per se. But when the reporting is required as per the CARO, an auditor has to report on each and every item and comment on each and every item, whether they are applicable. If they are applicable, they have to comment, and if not applicable, say this is not applicable. We all know that related parties is fines subsection 76 of section 2 and section 70 subsection 77 also. But what about the promoters? Because promoters, this is the definition of promoter, not necessarily the one who has signed the memorandum and articles or the float of the company, but for this who has been named as such in the annual report, which is to be filed. So MGT 7 and AOC 4 and MGT 7 form, which is filed with the Register of Companies, MCA, you must look at it and see that whether who are the promoters mentioned in the annual return, which is referred to in section 92 of the Companies Act. Who has control over the affairs of the company, directly or indirectly, whether it's a shareholder, director, or otherwise. So first is this, which has been explicitly mentioned in the annual return. Second is about the whether any person who is an influential director, who is influential, in accordance with those advice, direction, instruction, the board of director of the company is accustomed to act. This is very wide. This is very wide. It may include a person who is not specifically returned as mentioned as the director, as the shareholder, And in terms of Ind AS IFRS, there is something called the unstructured entities, sorry, structured entities. Now, structured entities are those wherein the percentage of the holding does not matter, where the percentage of the holding does not matter, and they are sometimes also known as a autopilot company, or the special purpose vehicles, or the special purpose entities. And in terms of US GAAP, is known as a variable entity. So this covers those items. Provided now, as far as the item C is concerned, there is a very sensibly logical exclusion that it will not cover those people in accordance with whose advice, directions, or instruction the board is acting or is accustomed to it. And this provided the person is giving his advice in a professional capacity. For example, a lawyer is, if he's advising a company or the board that you should act in this manner or you should not act in this manner, then those are known as the, this will be covered in the proviso 2 clause C. So 185, 186, I'm going to skip for a moment, though this is going to be there. Friends, I must tell you one thing. There are some set of chartered accountants who are developing or who are expert or specialized in certain field. They may be very good at income tax. They may be very good at GST, very good at accounting standards and auditing standards. But they may not be that conversant with the Companies Act. It's quite possible. They must have given this work, outsourced this work to the company secretaries or some third agencies or the parties. Nothing wrong in that. But now the days have come that you need to at least apprise yourself with some critical part of the Companies Act. That is, one of them is 70, section 73, 76, 180, 179, 180, 184, 185, 186, 187, and I would say 188 with the related, dealing with the related parties. And the various forms, to be filed with the forms and registered. Now, when it comes to section 185, I would say it reminds me MBP1, MBP2, and registered under MBP4. Correct, sir? So this is known as registered maintained under section 189 of the Act. So, friends, these forms you must read and take on record, because that will give some information which is not otherwise captured by your conversation with the client or the data mining with the client. So please develop some kind of understanding, awareness of these forms. MPP1 is a form which is in which the director mentions about his interest, and this he has to do in the very first meeting by which he is becoming a director. Very first meeting as a director he is joining or attending, and every year the first meeting of the every year. So suppose I join on say 15th of December 21. So I will make MBP1 disclosure on December 15, 21. And financial year 22-23, the first meeting is held on say 30th of April. So again in that meeting I have to make MBP1 declaration MBP1. What to report in case of non-compliance? Then these are the reporting requirements. I'm going to skip this, fans. Please allow me and forgive me. Of course, I have covered as much as possible in 85, 86. It's not applicable to which companies. Deposits, not a major change. Very well said by our chairman for the Ind AS and the IFRS committee. Gentleman Chintanji, this clause was there earlier in CARO 16, but in CARO 2020, they added one deemed to be deposit, and we call it deemed deposit. Friends, yes, very critical addition, deemed deposit. For this rule, 2 sub-rule 1 and clause C is very important, which states exclusive. For deposits, section 73, 74, 75, 76 are applicable. Section 73 basically deals with the private company. Section 76 deals with the public company. They call it eligible company. Now here in this case, I will go to this slide. Friends, these are the limits up to which the company can accept the deposit. I'm going to share this PPTs also with you, friends. But for the moment, I'm confining myself to this. Deposit includes any receipt of money by way of a deposit or a loan in any other form by a company, but does not include amount received from the central government, amount received from the foreign government and the banking company, loan of the financial assistance from the public financial institution or the insurance company, amount received against the issues of the commercial paper. Fine, we know that these are the financial institutions and banks, so obviously loan from them is not construed as a deposit. Again, amount received from any other company, intercorporate deposit, ICD, is not considered as the deposit. But I must tell you something. I am company B and there's another company A. And that company A is giving loan to me, that is company B. You should see that whether it contravenes the provisions or comply with the provision of section 185, 186, and 188. Make sure that that's what I have put a caveat here. Okay, amount received in pursuit of the subscription of the securities, including share application money or advance towards the allotment of share. Now here, if you received anything from the share application, if you receive anything on account of the share application money, this must be used for the allotment of shares only, or if not, then return the money back to the applicant. Friends, I must say that before, and I'm sure you'll all agree with me, that before the introduction of Companies Act 2013, the most common item which was there in the balance sheet of almost all private limited company was share application money. It was merrily sitting there since ages, sometimes since the date of incorporation. Companies Act 2013 has plugged the loophole and is say that it must be returned within 60 days from the receipt of money. It shall refund amount within 15 days from the completion of these 60 days. Suppose you accepted the money on 1st of January 2021 and the say 1st of October 21, then October and November. 30th November 21, 60 days are over. You should return this money by or before 15th of December, else it will be considered as the deposit, deemed deposit. Be very careful. So, and besides, there's a requirement of section 42 and 62 of the Companies Act. Now, this is deposit exclusion. An amount received from the person. Now, this is all covered by Rule 21C. Amount received from any other company. Sorry, any amount received from the person who, at the time of receipt of the amount, was a director of the company or a relative of the director of the private company. That means loan from director or private or their relative, which is defined under subsection 76 of section 2 of the Companies Act, is permissible. Conditions apply. Provided they furnish to the company at the time of giving loan, at the time of giving the money, a declaration in writing to the effect that the amount is not being given out of funds acquired by him by borrowing, accepting loans, deposits from others, and the company shall disclose these details of money so accepted in the board report. Very important, sir. This is very important. Many people forget about this, but I would suggest they don't miss out. This fact has to be mentioned in the board report also, and keep the documents with you. 3 words: borrowing, accepting loans, or deposit. One thing is missing: advance. If the director has taken advance for sale of his property, then this is permissible. Then that advance does not breach this requirement. So what it essentially means that basically the directors have to, or the relatives have to give this money from their own savings, past savings, capital gain, other income, sale of investment, but not the borrowing, accepting loans or the deposit. what a person cannot do directly, he cannot do indirectly also. Okay, because private companies are prohibited from accepting deposit from other than shareholders and the members. So you cannot say route this money through the conduct of directors. Amount raised from the bonds debenture with the first charge in this, any amount received from the employee of the company not exceeding his annual salary under a contract, non-interest bearing amount and held interest. This was earlier, or now it is being changed. Now means at least many years back, 4-5 years back. Any amount received in course of for the purpose of the business. Sir, in COVID, many companies have faced challenge that they've received money in advance from the customers under the assumption that they will give this delivery of that particular equipment within maybe 1 month, 2 months, 3 months, 6 months time. But later on, because of the COVID, they could not execute the contract, and as a result of which the money which is received from the customer has exceeded 1 year's time. Now let's read this. An advance for supply of goods and provision of services, provided the supply is made or the service is performed within 365 days. Whether advance is the matter of before any court of law, is not just disputed but before the court of law. If it is legally disputed, then this limitation will not apply. But this limitation has definitely applied during the COVID situation. As advance received in connection with the consideration of the property. Now, builders and developers, they know that they cannot give delivery, they cannot give the possession within 365 days. They take 5 years, 6 years, and number of times. So for the builder, this is not applicable. So make sure that this is being the goods are being supplied to them. If not, at least return this money within 15 days. I think it is there. Yes. However, an advance received from under A shall be deposited after 15 days from the date it becomes refundable. So if you receive the money on say 1st of October, then 30th September the next year it becomes due. So within 15 days you should try to make the repayment, else from November it will be treated as 15 November it will be treated as a deposit. And the repercussions are, it is not just a matter of nomenclature that it is deemed deposit or not. It is not just a matter of reporting, but there are very huge penalties for contravention of this provision. Becomes refundable. Now, the amount alone which is brought in by promoters or their relatives or the both in pursuance of the stipulation imposed by lending institutions on the promoter's contribution finance. Now, sometimes when the bank gives the loans or sanction any facility, it says that you also contribute your share. Okay, quasi equity, which used to say earlier. So, and that money is not allowed to be withdrawn during the tenure of this loan or the working capital facility. So if as a result of the bank's insistence and as a part of the sanction of loan, if there is any stipulations, then amount brought in by the promoters or the relatives or the both are not considered as a deemed deposit. And we've seen who the promoters are once again here. Any amount accepted by an ED company in accordance with the rules, any amount again by subscription to cheat fund, spelling is CHIT and not CHET. Again, then you should see the startup companies, there are exemptions for that. So startup companies, section 73 is not applicable. So this is about what is considered as a deemed deposit. And friends, I'll share this with you as well, that I call type 1 company, type B companies, and see that which is a startup company for 10 years from the date of its incorporation, a private company, so this is one link, that if it is a startup company, then for 10 years, no restrictions apply. It can take any amount of loan, and I call it type B company. For type B private companies, maximum limit no maximum limit apply. Otherwise, there's a limit of 200% and all this. And second, if it's a private company which fulfills any of the following conditions, which is not an associate, subsidiary, any of them, borrowing of such company or the bank is not more than twice the capital, such company has not defaulted on the repayment of the loan. Friends, when it comes to default for the deposits, whether the repayment of interest or the principal, there are many restrictions on such companies. All right. So then there was something called 185, 186. For this also I have covered here in this. No company shall indirectly give any advance to, including any loan represented by book debt. Though I know, friends, 185 is already covered, but I feel like addressing it because it's one of the very critical and most complicated standard. Company cannot give loan to director directly. Any director of a company in which the holding company or any partner or relative director, any firm in which the director or his relative is a partner. I will give an example which you'll see later on. This is all in terms of Gujarat, Mumbai 11, all in IPL term. Now, there is one thing: a company may advance any loan, including any loan represented by book debts, or give any guarantee or provide a security in connection with any loan taken by a person in whom any directors of the company is interested, subject to the condition that a special resolution is passed by the company in general meeting. So when it comes to section 186 also of the Companies Act, which talks about the limits to be complied with, make sure that this is limit, the company is given this authority when the limits are crossed by way of a special resolution. And explanatory statement shall disclose. Friends, Companies Act do require disclosures for the purposes for which the loan is going to be utilized by the recipient. But this is augmented by the CARO also. This is augmented by the CARO when it comes to the subsidiaries, associates, and JVs. To repeat, Companies Act, regardless of whether the loan is given to subsidiary, associate, or JV, requires this, that explanatory statement shall disclose the full particulars of the loans given, guarantee given, or the securities provided, and the purpose for which the loan or the guarantee or the security is proposed to be utilized by the recipient of the loan or the guarantee or the security. But this is again augmented by way of the CARO requirement. We'll see later on, sir. Now, this is the definition: any person in whom the director is interested. Again, I'm going to share this with you, friends. 185 is the permissible loan given to the MD, the loan given by the holding to the wholly owned subsidiary of the company. Again, they have to give the, this requirement is augmented by virtue of amendment in Schedule 3 to the Companies Act, that when the company has given loan to the subsidiaries, associates, and JVs, it has to also give the purpose for which these entities are going to use the loan. So now they've done the mixer and the combination and the connecting, I would say tagging of Companies Act, Schedule 3, and CARO. And again, related to the accounting and auditing, our accounting standards, like related to the related parties under AS and under Ind AS. Very important, the company, the prohibits company from making investment to more than 2 layers of investment. Section 186 is not applicable to the NBFC, but as far as 2 layers are concerned, it is applicable to NBFC company, and that's clarified in the CARO also. So friends, there's a lot more to say about section 185 and 186 company also, but as I told you, this has already been covered, hence I'm not going to dwell upon that. Okay, but allow me some time, and I'm going to share the Excel sheet, this 172 to 180 PPTs in the PPT format, not in the PDF format, and again the one about the deposits. The reason I'm asking 1 or 2 days is that I want to see again deposits. Are there any changes in that particular PPTs? Because that was done on 14th of July 21 for Surat. It was Saturday. No change in the cost and maintenance, so I'm skipping. So Mr. Computer G, please allow me to skip this, though I have put many clauses there. Now we are still at clause 3, subclause 3, and again 1A more, but and we have very little time. I may be a little fast, friends, allow me. They audit only one thing, goods and service tax. Regardless, besides that, there is no other change. This is the same thing again, no major change, no change rather. No change, no change, no change, no change, no change. So green is not vegetable and red is not the non-veg, but this is, I don't know what is there here. Okay, maybe some. Now, whether the transaction not recorded in the books of account have been surrendered or disclosed. So this does not cover the investment and the disallowances under section 69C, 69D under the Income Tax Act, wherein they say that you invested in shares of the company and this company is bogus. This company is a penny stock. They are not talking about it. Basically, an item should not be in the books of accounts. Because all those who are into the income tax practice must be aware of it, that sometimes unexplained investments are covered, are being taxable, are being taxed. So the important word is surrendered and or disclosed. It's voluntary. When the survey actions are being taken, conducted, they make the assessor to make some declaration. So this is known as the surrender or the disclose. But if this sentence is retract, then this clause will not be applicable during the year as income. So it always remember, during the year, beginning of the year, at the end of the year, or previous year. So this is about it during the year. If so, whether the previously unrecorded income has been properly recorded in the books of accounts in the year. Friends, I am also to the income tax practice, and we come across some raids in survey actions. I was advised, honestly, by then Deputy Commissioner. He said, Mr. Desai, you must do one thing, that whenever your client surrenders, disclose, they call the word declare. हमने 50 crore declare कराया, 40 crore declare कराया. So declare कराया means surrender or disclosed. You must bring this capital in the money in the capital. Now suppose, for example, the declaration for as under 25 crore rupees cash and 25 crores unrecorded land or the buildings or some investment in jewelry. So entry should be cash account debit, land account debit, jewelry account debit to income, capital account, or maybe income. And then that's why I used to do it. This is about very good old days in 86, 87, when I started my career. So initially the raid survey action at that point of time was very horrifying, because in the initial stage of your career, if you come across, you see 5 stars, nothing else. So entity has surrendered disclosed income during the year. So your onus should be that whether they have been booked in the books of accounts or not. Then there's a lot of debate and argument as to what is considered as surrender, what is not considered surrender. Undisclosed income includes any money, bullion, jewelry, I would say now the cryptocurrencies, other valuable article things, and income based on entry in the books of account. Okay, property which has not been, would have been acha. In other words, okay, or any expense deduction allowance claimed under the act which is found to be false. So your declaration, your disclosure, your surrender should be also about not just the income or the assets, but also about the expenses. And very recently I saw it today that there is one entity where there was a raid, there was a huge expense, bogus expenses. So that I think now that auditor should look into that. So you should be in touch with the tax consultant or the gentleman who is handling the tax account, because for the contingent liabilities, we do obtain the declaration from the chartered accountant or the consultant who is handling the tax matter, that please you give us the income tax status report, because nowadays you get the tax demand status from the IT records. The emphasis on the word surrender or disclose, which implies that the company must have voluntarily admitted to the addition, which can be demonstrated on the basis of the returns filed by the company. Now, friends, I tend to disagree with this, that voluntarily. Now, voluntarily is this possibly, but very important word which I like is on the basis of the returns filed by the company. Now, statement in the course of the survey to verify where, however, the statement has been retracted on the ground that such disclosure was obtained under the false caution, etc. The income cannot be treated as surrender or disclosed by the company. So this is very important. I mentioned at some point in time that you need to ask whether the statement was retracted. That means whether the statement was withdrawn by the client. Might relate to any assessment year, very important, not necessarily the current financial year or the year under question. It could be anything. And then when it comes to recognition of this, how do you recognize the income? I give an entry, bank account debit, cash account debit, and the other assets account debit and income account. So as far as AS5 is concerned, it is covered by this prior period item as a separate line item and again as an exceptional item. As far as Ind AS is concerned, it will be covered by paragraph, it will be covered by Ind AS 8, accounting policies changes. And then that means then again, it depends whether in the declaration you have declared this income of year 2, year 1, year 4 or 5 or whatever it may be, and accordingly you will apply the requirement, whether you need to restate the financial statements of the preceding year. And well, depends on whether you are applying, whether it relates to the comparatives or beyond the comparatives. And as far as Ind AS is concerned, declare this as an exceptional item because extraordinary item under Ind AS is not permissible. Now, this is another clause 314 where the company has, this is a green light, so I'm feeling happy. But I have put some materials there. Defaulted in the borrowings. Now, borrowings do not include the public deposit reporting on the public deposit covered by another borrowing. Because for default in deposit, there are other standards. Even the preference share capital should not be considered as a borrowing. Ind AS may say anything, but you apply a different criteria. Whether the company has defaulted in repayment of the loans has been covered. So earlier it was only the repayment of the borrowings of the loan, but now they added or in repayment of the interest thereon. Pardon me, sir, I don't like to do so. Honestly, yes. Declared a willful defaulter by the bank. Till now, I was mentioning about visiting Companies Act, rules, forms, declarations, accounting standards and auditing. Now adding one more echelon, and that's the Reserve Bank of India circular. I'm sorry, I forgot one thing, that when it comes to deposit, companies have to file a DPT3 form. DPT3 form. If I'm not mistaken, by or before the 31st May either or 30th June. I'm not too sure. So DPT3 forms also includes and have the information about the deposits for the immediate. So by the time we all know that for private limited company, our date of signing report is maybe September 30th. So by that time, DPT3 form and MSME form has been filed. So you please refer to DP3 when it comes to deposit, when it comes to deemed deposit. Of here, it says that whether the company is declared willful defaulter by any bank or financial institutes or the lender. Now, it missing out this year, which year, and what do you mean by willful defaulter? As the name indicates, we know to some extent that जानबूझ के मैं पैसा नहीं दे रहा हूँ. I have money, but I'm not paying you. So it is known as a willful defaulter. We have seen there are many examples of the willful defaulter. appearing covers all banks, including, okay, this is very important, to which amount is due finance, provided it's arising on account of any banking transactions. Oh my dear, it's not talking about the borrowings only. It could be any other banking transaction. And that's why they say, including off-balance sheet transactions such as the derivatives, guarantee, and the letter of credit. So they are not saying borrowings, but they are going one step further. Any banking transaction, which is a wider gamut, okay, is required to report whether the company has been declared a willful defaulter by a bank or the other financial institutions, restricted to go to related until restricted to go to the relevant financial year under the audit till the date of audit report. Government may also sometimes declare an entity as the willful defaulter. Now, refer to the master circular of RBI dated July 2014 as now these are the various instances where an entity may be declared as a willful defaulter. But very see, if you see, except why except in all the 4.1, triggering event is a default of interest and or principal. So whether so that's a triggering point to look into whether there is a willful default or not. Unit has defaulted in meeting the repayment obligation to the lender, even if when it has capacity to honor the pay. है पैसा नहीं देना है, आपको जो करना है कर लो, हमको पैसा नहीं देना है, केस करो, fine, go ahead. I don't want to pay. The unit has defaulted, even diversion of funds is considered as a default, willful default. Has defaulted in meeting the repayment obligations to the lender and has not utilized the finance from the lender for the specific purposes for which. So big danger. You have taken money, and this is mostly the case when entities or someone withdraw money or takes money on the LAP, loan against properties. Because we have been doing this for a few banks and few of our clients, that when I borrow money from the bank LAP, then I have to give every quarter the purpose for which I am utilizing these funds, because they say that you cannot invest these funds in a few restrictive uses. I have been asked, I have been restricted not to use money, say for example in the share market, but still, and I have taken under the pretext that I want this loan for my son's education, and I am using this money for the investment in share market. I am known as a willful defaulter. But in very important is defaulted. So what does it mean? If I'm not defaulted, I will not be considered a willful thing, because here he say that even if you have diverted the funds, the basic condition is the unit has defaulted in meeting its payment obligation to the lender and has not utilized. It has not used the word or. The unit is defaulted in meeting its repayment obligations to the lender and has siphoned off the funds. So triggering event, in my opinion, is default and or of interest and principal. The lender has siphoned off or removed movable property given by him in for the purpose of securing loan without. Okay, this is something dealing. This is more dangerous. You have given security. You have given some security to avail the loan. You've defaulted and you sold off the properties. How? Jugaad. So these are known as a willful defaulter. Just wait. Okay, there's one message by my colleague. One of my colleagues, he's also looking at it. He's also watching it. He says, "Sir, you missed out one thing in the initial criteria. And what is it? Borrowing. So the criteria for the applicable of the CARO, the exemption are the paid up share capital and reserves and the borrowings. So this and in the standard has this guidance note has mentioned very clearly that even the borrowings from the credit card is also considered or also taken into account for deciding the limit of the borrowings. Borrowings by the company on credit card is also one of the borrowings. The cases where either the government or any government authority has declared the company to be willful defaulter during the year and after the year, and even after the year. But okay, now in many cases, In many of these CARO coverages, there could be a situation where something has happened during the year. So in that case, it is the onus of the auditor. But something has happened during the subsequent period, known as the reporting date and the date when the accounts are authorized for the issue. These are known as the subsequent period. Now, depending on whether if it is adjusting event or not adjusting event, but entity auditor has to take into account. So in this case, if not declared as a willful default but declared during the subsequent period, if not declared as a willful default during the financial year but declared during the subsequent period, this is considered as an adjusting event. That means even adjusting event or non-adjusting event. What if this? So in this case, but before the year end, he has to take into account about willful. Now, what if the above show cause notice is received by the entity? You have defaulted, but you received a notice. Then, so in that case, it is a matter of advisable to disclose. Now, here are the examples of the reporting given in the standard. I put a green mark because that is you can see it from the standard, from the guidance note, or even copy from this. Whether the term loan were applied for the purposes for which the loans were obtained. Now, hereafter, you'll see as far as this subclause 9 subclause 9 is concerned, there are, I think, 6 subclauses, six subclauses. They are so much concerned about the utilization of the funds for the purposes for which they've been obtained, whether they are regular in repayment. At the same time, when it comes to the loans given to, guarantees given to securities of these associates, JVs, and the joint ventures, there are many wide disclosure requirement, reporting requirement. These are all new. Whether the term loan applied for the purpose for which it was obtained, if not, the amount of loan so diverted and the purpose for which it may be reported. So if I have taken loan for the land, but if I'm used for the building, you should say that is. And what is term loan? In the common parlance, is the loan which is a repayment period of more than 36 months. Cash credit, overdraft, and call money are not covered by the term, by the expression term loan. So they are only talking about this thing. Then they say what are the diversion of the funds? Again, a short-term working capital funds for long-term purpose, not in conformity with the term of. Now this could be working capital term loan also. Deploying the borrowing funds for the purposes, activities, or the creation of assets other than the fund for which is option. So all these are known as the diversion of funds that has to be taken into account. Now they say that it has to be used for the purpose for which it has been utilized, but standard these guidance notes use the word no one-to-one relationship to be established. I go one step further and I would say no nexus to be established. That you received money, because money is a fungible commodity. I received funds on 1st of April 21 and I deposited in my account, and then from there I used to. The point is that no one-to-one relationship, no nexus to be established. So far as use the funds for the particular purpose, it's okay. But sometimes it happens that you have you've taken the loan and then parked the funds temporarily. Park the funds temporarily. So this does not amount to diversion of funds. Company might have acquired or improved. Okay, now this is one more thing that I have decided. I have taken a loan for the Intel Core i5 laptop, but then I decided to go for i7. So this does not mean that I have not applied the funds for the purpose for which I have taken the loan. So it may happen that the company might have acquired improved version model of the asset as against the asset for which the loan was sanctioned. Correct. So that does not tantamount to breaching of this code. What tantamount to diversion? Would this amount to diversion? If in this case, no. What if the funds are temporarily invested? No diversion. What if the loan is received at the fag end of the year end? You received the funds on 25th of March and you're not able to use these funds. You're not able to invest these funds. 3 days, 2 days bank strike. And thereafter, again a strike by the stamp duty department. And you are not able to register the document. So that does not amount to diversion of funds. Now again, in this, if the debt instrument is required to be split into debt and equity, then it should be treated as a debt only and not to be bifurcated. So entity will see a total debt instrument and not as debt and equity. Wherever he thinks that the funds were not applied, it should report that how much has been diverted and for what purposes. Then again, this is again, as you can see that for this clause, there are 6 sub-clauses. Where the funds raised on the short-term basis have been utilized for the long-term purpose. If yes, friends, the whole idea of CARO revised is to just get the reporting on the management of the funds, borrowing of the funds, utilization of the funds. Don't go beyond layer of 2. So we have umpteen number of examples where how the big companies which has more than 385 subsidiaries, associated JVs had created the jumble and the jungle of the related parties. Okay, so default by the companies, cheating by the companies, cheating by the promoters, siphoning of fund have prompted Companies Act, MC, or the regulators to come out and to tighten the grip on the reporting requirement. And ultimately, the burden is on whom? The burden is fortunately on the person whom the regulators rely on, and that is nothing but the chartered accountant fraternity. So they believe you. They will believe you. If you say, yes, this has been done, they may accept you, at least to begin with, prima facie. So we have to discharge our duty, owner's duty, very diligently and honestly and prudently. Investing money from overdraft facility in long-term investments, so and or subsidiaries. So you taken money overdraft facility, which is normally meant for the short term, and then you use fund for buying properties, for giving or investments, giving money to joint ventures for the long term, or the strategic investments, that is not permissible. So if yes, the amount to be indicated. That's it. You don't need anything. If the short term, then for this you need to you read your balance sheet, short term, long term investment. Now, not just read the balance sheet, but read something else. I think I've mentioned here that current liability is something different, and what you have to see is something different, because current liability is the current portion of the long term liability. Ideal management of the funds borrowed short term for the short term and long term for the long term. Yes, a long term working capital may be used for the short term. That is permissible, because there's a very overly secured strategy, but there's nothing wrong, because you've taken the working capital term loan. If the funds raised for the short term is used for the long term, is not a prudent policy. It's clarified that the current maturity of the long term, which are included in the current liabilities as per Schedule 3 to the Companies Act, are to be treated as long-term source of the funds for the purpose of reporting under this clause. So don't just go by the balance sheet saying that, look, this is the short term, this is the current liability, this is the long-term liability, but that you need to reshuffle this classification from the perspective of this CARO requirement. So for the limited purpose, you should add this back to the long-term liability and treats current portion of the long-term liability as a long-term liability. Application of fund which is not a long term may be true. If the long-term investment is less than the long-term fund borrowed, it is an indication that the short-term funds have been used to finance the long-term. That means long-term borrowings are only 1 crore and the investment is 2 crore. That means you have used the funds from the short-term finance. Very sorry for typing error. The current ratio. The current ratio is less than 1. If the current ratio is less than 1, also this is an indication of the fact that the short-term funds have been used to finance the long-term assets of the company. This is all given in the guidance note, sir. Again, I'm repeating and giving the full accreditation and the credit to the ICI, which has come out with a wonderful document called guidance note. For the purpose of calculating the current ratio, the current maturities in long term should be considered as a non-current liability, like the way it was mentioned here. Cash flow statement may also be pursued. Then you should see that what are the now this is again the indicative reporting requirements. So I'm just skipping it. Now 3.9 clause. Who is there from the ICI side, sir? Hello, Mishra ji,
sir.
or any
Yes.
convener?
Yes, sir.
Along with Mishra ji, who is there, sir?
Sir, Misha Bora बोली sir.
मिश्रा जी ये कुछ एक्सटेंड करेंगे चलेंगे प्लीज टेक द कंसेंट ऑफ द participants. Whether the company has taken any funds from any entity, again you see this is 3.9e. Now you see there is one more F. To meet the obligations, now they say that if the company has taken any money and to pay to the joint ventures, subsidiaries and associates of the company, you should disclose it. Now, to meet the obligation of I think they use the word obligation, to meet the obligation of the subsidiaries, associates, and joint ventures. If so, then the details of this nature. Again, they have given the table for that, which is there. Funds will include both long-term and short-term funds. The word obligation means, in the normal parlance, obligation to meet any debts, securities such as the mortgage or commitment to pay, but it's also include anything which a company has to pay to the vendors, to the lenders, to the employees, and the statutory authorities. So if you are taking loan and you're paying on behalf of associates, subsidiaries, or the joint ventures, you should disclose this, report this. Now, again, they say the auditor should review the cash flow statement of the company. Positive cash flow from the operations, positive cash flows from the investing activities, and incomes when it comes to financing activities. They are not talking only about positives. They say that in terms of the financing activities, when the proceeds have been received from the issue of equity instrument and all this, then it is safe assumption that the company has not borrowed funds to pay the obligations of this thing. Now, this is very important. The CARO says that you made the obligation of the subsidiaries, associates, and JVs. But if it is from our own fund, no reporting. It is to be reported only if the funds have been borrowed by the parent and then met the obligation. Now, again, this is about the pledging of the securities of the. Now, this is the reverse of that. In the earlier case, in the case E, you had borrowed money and paid for the company. Now here, you borrowed money on the security of the assets of the subsidiaries, associates, and JV. If so, give the details thereof and also the report. If the company has defaulted. Now here they added one more thing. Whether the company has raised loans during the year, again during the year, on the pledge of securities held in its subsidiaries, joint ventures or associates, and if so, give the detail thereof. And also report dual requirement if the company has defaulted in the repayment of loans raised. If yes, give the details thereof. Report if the company has defaulted in the repayment, yes or no, nothing else. Nothing else, sir. As the defaults are in any case required to be reported in the 3.9a, as far as just report, not the details of the report. And also report if the company has defaulted. They are not asking for how much interest default of the principal of the interest and how much. They are not talking about it. All loans taken during the year, even if they have been repaid. Now, very important, sir. It does not say. So time and again, I say it does not say whether it has been repaid or not, whether it has been outstanding of the year at the end of the year, but all loans raised during the year. Reporting only in case of loans taken during the year. Loans taken in the earlier and outstanding at the balance sheet date need not be reported. Default will include both payment of principal and interest, covered cases where the security have been. It also covers the cases where the securities have been invoked. You've given the securities and these securities have been invoked. Now this gives the definition of what is a property and what is a security from the Indian Contract Act to verify CHG1 and CHG4 lodged with the ROC and MCA. This one is for the creating charge. This is for the season of the charge. And this is a requirement of the reporting. Example of the reporting. Initial public offer for the public, including debt instruments, so not just the equity, but including the debt, during the year were applied for the purpose of which were raised, if not default, details together with the delay. Now, few friends, as you see that time and again, they are insisting on the utilization of funds, diversion of funds, willful defaulter, amount given to borrowed from the JVs and all kind of thing, because they not to see that the funds should not be misappropriated. They discourage the practice where the funds, when the management plays around with the banks or the financial institutes. But for this, it's not difficult, because if the company is listed, then it is covered by the SEBI requirement. If the company is not listed also, then again it is required by the Companies Act and the rules for the raising of the public. When it is the initial public offer, naturally is going to be covered by the SEBI red herring prospects and other requirements. As suggested, in our opinion, again, this was there earlier also, so I'm not going for that. Oh, I'm sorry, I didn't realize the green signal. Fraud is also covered earlier, but they've added two more items in the fraud, and that is again A only. Now you'll see fraud B. Okay, whether they added only one thing. Earlier it was officers and employees, but now it is only the they removed this word, so they widened the scope of this reporting. Now this is again talking about the ADT4. ADT4 is also required to be complied in case there is a thing. Now this is again ADT4 they're talking about, yes. So whether now this is the requirement of the fraud, as I mentioned to A is B and C, yes. So in this case, whether it has been flagged or not, and one has to follow the procedures given in section 143.12, that you have to give time to the board or the audit committee for about 45 days, and if you don't receive any response from the audit committee of the board, then within 15 days the company has to, the auditor has to file ADT form, ADT4, and with the MCA. Whistleblower complaint. Now, as far as this is concerned, whistleblower is again a part of the audit committee requirement also. Every listed companies which accept deposit from the company, and the companies which have borrowed money from the banks in the public finance industry in excess of 40 crore. So friends, MCA has noted that many companies have defaulted. Many companies have defaulted here as far as this is concerned, because when the company has borrowed money more than 50 crore rupees, they have failed to have the whistleblower policy. Again, these are the requirement of the SEBI. These are the sample reporting, so I'm skipping it. Nidhi company was already there, though I've covered part of the Nidhi company. Related parties also was there. Internal audit, the new clause is added. Company is internal audited commensurate with the size and the nature of the business. Now, in this case, it's a matter of judgment, but there is one thing. This is applicable even to private companies also. If the turnover is greater than 250 crores and the borrowings from the bank and the financial institution, now this borrowing could be of long-term, short-term, fund-based, non-fund-based, all kind of limits, and that is about 100 crores. I think for 100 crores, there is a secretarial audit requirement also for the current financial year, maybe 2021 onwards. In case of unlisted company, these are the various limits. Who can be the internal auditor? A partnership firm or a body corporate also can be, because a body corporate cannot be a auditor, and that's why they say that LLP is considered as a body corporate. but for the limited purpose of the audit under the Companies Act, it is not considered as a body corp. Qualification need not necessarily be chartered accountant, but always prefer to be chartered accountant, of course. And even the employee of the company could be the internal auditor, but make sure that he's being appointed by the board. Now, whether it has been considered or not, this has been now possibly made a part of the reporting, because otherwise, as per the standard auditing 610 is concerned, it was already there. 600, 610, and 620 are very important. Same as CARO 16, that is non-case under section 192. Reporting examples 45(1)(a). Now this is something very important. Now there's two standards with two clauses which are very important. One is about the cash losses in the financial year and in the immediate preceding financial year. Sometimes it may happen in the preceding financial year there's a cash loss, in the current year there's a profit. It may happen last year it was a cash profit and this year it is a cash loss. Now in this case, cash flows is not defined in the Act, is not readily available, so auditors have to do some exercise. Need to be distinguished from the distributable surplus and the realized or the profit losses. Is not the same as a negative operating flow, very important, because that is something, because for the calculation of the operating flow, the items are different as compared to what. So now the standard says that for companies following the AS, that is a non-Ind AS company, PAT, profit after tax, is adjusted for the effects of the transaction of the non-cash nature, like depreciation, property, plant, equipment, amortization is 26, and the impairment losses, or its reversal, mind you, or its reversal. So depreciation is to be added, impairment is to be added back to the this thing, and profit after tax, and if it is a reversal of the impairment loss, that is to be reduced. Would require for the non-cash items such as the deferred income tax expenses, foreign exchange gain and losses, unrealized. We need to add that. Fair value of the changes in the determination of the cash losses. So there could be a fair value have been added as an income, more so for the Ind AS company. For Ind AS company, the PAT is adjusted for the effects of the depreciation. They've added 116 ROE asset, amortization of this thing, impairment or loss or reversal of impairment, though not specifically mentioned in the guidance note. ECL, expected credit loss provisions pursuant to Ind AS 109, also should be added back, is also considered as the non-cash item. Effect of qualification of the report, fine. If loss is a 1 year profit, give the separate reporting requirement. Now, resignation of audit is something which is, someone was telling me, I came across this physiology, that the plight of the auditor is to sign or resign, to sign or resign. And that has become very, very common phenomenon now. And so far say that, if I'm not mistaken, there's a guidance note by the ICAI on the resignation also. Now this is applicable where the new auditor is appointed during the year to fulfill a casual vacancy caused by the resignation of the auditor created in the office of the previous auditor under 142, because casual vacancy can happen because of the incapacity of the auditor, when he's buying the share of the company, is disqualified, when he's unfortunately dies, or leaves India, or like this. I mean, he dies or he surrender his certificate of practice. So not those vacancies, not any and all vacancies, but the casual vacancy caused by the resignation of the auditor. That this does not cover change of auditors pursuant to the mandatory rotation. Very important, sir. So it covers only the a non-routine item of the resignation of the audit. Again, ethics have to be looked into account. Now this says that it has to be filled in within 30 days, and ADT 3 is required at the time of filing at the time of resignation. ADT 1 is required at the time of appointment of the auditor. Okay, this is the guidance note. Implementation guidance note on resignation, withdrawal from an engagement to perform audit of the financial statements. So this has to be also pursued. Reading the minutes of the board of the meeting, inquiring and exercising professional judgment, reporting requirement, clause 319. This is something very important. Now here they want us to be a clairvoyant. एक भविष्य वेता हम बने ऐसे चाहते हैं. On the basis of the financial ratios, aging, and expected dates of the realization of the financial assets and payment of the financial liabilities. Expected date of financial assets and liabilities. Friends, I have written down somewhere because I forget so many things. Page 213. Yes, page 213 of an annual report. Page 213 of an annual report. I'll just come to that, and because that is a requirement under the Ind AS 107 for the Ind AS companies, giving the maturity tables of the assets, of the financial assets and the liabilities. Oh, they've used the word financial assets and financial liabilities. Now again, this is as per the Ind AS. Financial asset is the right to recover cash or any other financial assets of the any other company or financial assets of the other entity. Whereas financial liability is an obligation to pick cash, that to cash, not adjustment. Other information accompanying the financial statements, the auditor's knowledge of the board of directors. So they have to see the management discussion analysis and all this. No material uncertainty exists as of the date of audit report that the company is capable of meeting liabilities existing at the date of balance sheet date as and when they fall within the period of 1 year from the date of balance sheet. Just allow me a minute, friend. Allow me a minute. I was referring to a document.
मैं स्क्रीन स्टॉप किया सर.
हाँ फ्रीज किया ना मैंने.
स्टॉप किया
Can
आपने
you-
स्क्रीन.
हाँ स्क्रीन स्टॉप किया. एक मिनट, 1 minute please. हाँ,
Okay.
I've freezed it. I just want to demonstrate the participants that page number 213, and now I'm opening it. Mishraji, can you see now the screen?
Sir.
Mishraji, can you see it
Yes,
now,
sir.
please?
Yes, sir. Yes, sir.
Okay. So for one in Ind AS, pursuant to Ind AS 109, management of the liquidity risk will be of some help to the auditor. At the same time, the financial assets and liabilities have to be they have to give what is the maturity analysis of the financial liabilities of the company and assets. Carrying amount is so much, of which how much they're going to get in 1 year's time and how much they're going to get beyond a year's time. Okay, so this auditor then to see that how much is payable within 1 month, 1 year's time, and how much is going to be received in 1 year time. Okay, no, sorry, this is the comparative, and same is the case with the receivables also. Then there are management of the risk, price risk, interest risk, foreign exchange risk, management policy, foreign currency exposure risk. All this should be taken into account by the auditor for deciding for playing these rules. Now can you see the PPT, sir? Mishraji? Hello?
Yes, sir. Yes, sir.
Yeah, okay. There's no requirement of this prediction by the auditor, but it is now included in the CARO, and it say as per AS1, going concern is a fundamental assumption. Under para 27 of the AS, disclosure is warranted if the assumption is not followed. So assumption is fundamental. That means even if you don't mention, the reader will presume that the company has followed the going concern approach for finalizing. And as far as para 25 Ind AS 1 is concerned, it requires that management shall make an assessment of entity's ability to continue as a going concern, and the foreseeable period here is 1 year time. But there is a difference in the going concern and this para. I have come across many balance sheets of private company, that despite losses, the accounts were prepared as per the going concern assumption, because there's a support from the holding company or from the promoters. So despite losses, the company is still running, treated as a going concern because of this support. So the criteria of going concern as per the accounting standard is A, that is something different from ability to meet its obligation. So the point is that if an entity is using the going concern assumption because of the support letter from the promoters or the holding company, but when you look at the accounting standard, it may not be possible, right? Because when it comes to the meeting the obligation in 1 year's time, it may not be possible. I use the word it may not be possible, not necessarily always. The liabilities to be examined for the payment should exist at the date of the balance sheet, which falls within a period of 1 year from the date. It should be noted that the liabilities falling due within the period of 1 year. Now, again, there is a mismatch of the definition. A liability which is falling due within a period of 12 months does not necessarily mean that you have to pay within 1 year time. For example, if an item is a part of the operating cycle, or if it is a part of the trading, it is meant for the trading, or if there is an unconditional right to defer the liability beyond a year's time, then in that case, an amount is treated as a current liability. But it does not necessarily mean that the company will be able to meet this obligation in a year's time. Definition is as per the financial assets and liabilities given in Ind AS 22. On the basis of accounting ratios, directors' reports, management plan, management discussion analysis. Relevant ratios are liquidity ratios, which is the current ratio, asset ratio, cash ratio, efficiency ratios like the turnover ratios and all this, and refer to the 11 ratios given in the Schedule 3 revised. Other information, MIS, cash flow projections. They may have done the impairment test. So look at the cash flows given for the impairment test, because they use something called value in use. Projections given to the bankers for availing the loans. Assess the assumption in the management, the minutes of the meeting and the board of directors. Special consideration for the Ind AS company disclosure and the maturity analysis as per Ind AS 107. For NBNC, there is something called asset liability maturity, same as 107. Okay, and last is the about the CSR. CSR is a separate field by itself. No wonder that after IIA, they may come out with CSR, chartered accountants. So basically, there are two types of ongoing, two types of projects for the CSR. One is the ongoing, second is other than ongoing. For other than ongoing, it is a 6 months time that within 6 months time, they should deposit funds in the a specific bank account called the unaccounted, unutilized bank account, unutilized fund in the scheduled bank. And I'm going to come to that there are some specific funds within which the fund has to be invested under some circumstances. Now CSR2, this is the latest thing which is happening. The CSR2 form is to be launched before 31st March 2022, and which contains concerning the amount utilized, unutilized, blah blah blah, everything concerning the CSR funds for the ongoing, for the other than ongoing project for the year ended 31st March 21. Friends, I insist you must read this form. You must pursue this form. And secondly, on August 21, there's FAQs by the CSR, FAQs on CSR by the ICI, friends. You must read this. And needless to say, you can find this out, not denying about it, friends, but I'll share this transaction with you, these documents with you, which Computer G, yes, about the applicability of the CSR, whether the has not implemented 3 years, completed 3 years time, listed company, unlisted, and the treatment of the unutilized funds, whether the offsetting is done or not. But offsetting is allowed only after 22 January 21. Okay, now 22 January 21. Yes, it is 22nd January 21. There was one recent judgment, but this again will be changed by the IT Act that CSR is deductible. Normally it is not deductible, but I don't know how this judgment came. So this document is very important, friend. This I'm sure you have access to that, but still I'll share it. And then guidance note account of the corporate social responsibility. Whether the company has transferred the unspent money to the account other than going for this, there is a period of 6 months time, and treatment of the excess spent on this carry forward is only for the financial year 2021. Sometimes they say that you deposit money in 6 months time from the end of the reporting period, and you're reporting say on 29th of May. What happens in that case? You have to mention that the company is not transferred the amount remaining unspent in respect to the ongoing projects to a social special account till date. However, the time for such is 30 days from the end of the financial report. I have seen in that case you should cover in the first QR report. Now, if the unspent amount has not been transferred, then it is to be transferred to specific funds called Contribution to Prime Minister National Relief Fund and the PM CARES and any other fund setup. This was for the not ongoing project, and this is about the ongoing project. Unspent corporate social responsibility account. Here the time limit is just 30 days. Qualification. Now CARO is like CARO 2020, like CARO 16 is not applicable to the consolidated financial statements, 7 except this clause, whether there have been any qualification or the adverse remark by the respective auditors. So only to that extent for that particular paragraph it is applicable. Otherwise, CARO 2020 is also not applicable to the consolidated financial statements. Friends, as I mentioned earlier, it was a humongous task because my one session, in other cases where we impart corporate training, the deemed deposit in section 73, 74, 70, and 76, that itself takes 1 full day. That itself takes 1 full day. Correct? So imagine if I have to cover everything in 2 hours time, it was difficult. It was a challenge, but I tried my level best. Okay, now let me see a few questions. Which government website provide the willful? RBI, Reserve Bank of India. And my dear friend, I have mentioned the Reserve Bank of India circular number. I is a such type Reserve Bank of India willful defaulter, and it's covered in one of my slides. Whether the lease liabilities as per Ind AS is covered in the reporting on the borrowing. Yes, it is covered because sometimes in some cases they say borrowing from the bank and even others. Borrowing from the bank and others. But mostly, my dear friends, banks and financial instruments institutions are covered. But as a prudent policy, there is no harm in declaring those things. Whether the scrap sold by a company is added to the at a higher value than the higher value by AO, say the script sold at 100. AO tool rate at 150 and added 50 in income, whether this is reported in CARO, the company is not going to get additional 50 gram from the buyer, so not going to account in the books of account. Now, this is not something which is contemplated by the standard, which is not something which is contemplated. This is this big. And my dear friend, do you think it's going to be challenged? Is it voluntarily? Hello, can the question number 3 was asked by some gentleman. Can you please come alive? Hello, can you please come? Can you come alive? Say, when I say, can you please raise your voice, raise your
Yes,
hand?
sir.
हाँ जी, नमस्कार.
नमस्कार सर.
नमस्कार. आप प्रश्न पूछने वाले जनाब है क्या?
मैंने क्वेश्चन दे दिया ना सर सामने.
अच्छा.
स्क्रीन पे देखिए.
This is not surrendered. This is not. This may be treated as a under 69A, unexplained investments or unexplained resources, but this is not surrender. So CARO to such case, question number 3 is not applicable. When any income tax addition made by the AO, that is disallowance, will it be treated as an unrecorded transaction for reporting under the clause 8, although recorded in the books, but disallowed? Now, this 8 clause is talking about unrecorded transactions, but surrender willfully. Hello, are you getting my point here? In para 3 regarding the providing guarantee security, the word mentioned is other parties. It can be concluded that all guarantee given to vendors for securing payment has to be reported. Well, it is a matter of a judgment, not too clear, but hello. I'll come back to you. I'll do some research for this question. Hello, question number 5. I need to come back to you, but ideally it could cover other parties also, vendors also. And this is more often now the supply chains and all this. मिश्रा जी, कोई क्वेश्चन था कि इतने ही क्वेश्चन है?
बस सर इतने क्वेश्चन है सर.
इतने ही क्वेश्चन है. चलो. So then, can I take leave now? Can we conclude? Hello.
सर.
Hello. हाँ.
हेलो केतन सर. संकेत
Yeah.
सर. हेलो संकेत सर.
Good evening, sir. Good evening, sir. It was a very wonderful.
Good evening.
Hello.
हाँ जी.
Sir, can you hear me?
Yeah.
Yeah. I think there is some.
Some problem?
Yeah. I'm.
सर थैंक्स करिए सर.
Yeah. Now it's okay. Yeah. Good evening, sir. It was a wonderful session by yourself, and we are delighted to hear you on such a nice CARO 2020 presentation and amendments. And I hope that all the participants would have enhanced the knowledge on the CARO 2020, and it will be useful for finalizing the financials. And on behalf of WRC, I am very much thankful that you have shared your time, precious time to us, and share your knowledge and enhanced our knowledge also. I am very much thank you, sir, Yagnesh sir, and on behalf of WRC also, I am thankful to you. Thank you very much.
Thanks so much. Thank you so much, everybody. And it was my pleasure to give me an opportunity to share my knowledge of the RAO with my professional brothers.
And sir, it's a humble request that you share your presentation to us so that all the participants will
whatever I have presented and whatever presented, which is from my old resources, I'm going to share with everything with you. Everything.
Thank you very much. Thank you very much, sir.
Yeah.
It was your pleasure, sir. Yeah.
Okay. Thank you. Thanks and all the best to the participants. God bless you.
Bye, sir. Thank you, sir.
Thank you.